The Hedgeless Horseman here. It's April 4th. Well, it's already 5th here in Sweden. Anyway, first of all, thanks to the sponsors. Let's look at what the markets did today. It was a very weird day. Stocks seemed to have held in there for a long time. All of a sudden, they start to semi-crash. Um, the metals held in there as well and actually went higher, and then they turned down, and crypto actually did okay the whole day, and it's like broadly speaking as well. So I mean, in my opinion, I mean this is probably some of the wackiest markets we've ever seen. Not much really makes sense. So risk off for whatever it was in the stock markets. Gold and silver again hung in there, and all of a sudden they sold off, and you can see the kind of choppiness here. And this was obviously quite a slam. Cryptos untouched, so you know it's like I was gonna say the retail Western investor who sure didn't go risk off. I mean, whenever Dogecoin is close to zero, we'll know it's actually some fear out there in the market and balance in the universe has been restored. Until then, I think this uh, meme coin has still a market cap around 30 billion or something. Anyway, I mean that's of course kind of why I think this is such an attractive uh, environment we are in. I mean, for a value investor, it's like a walkover, especially a hard asset value investor. I don't think people have seen anything like it. I mean, the veterans say that they haven't seen this kind of dislocation between price and value since early 2000s. And yes, we've had a bounce in the juniors somewhat, but those are from extremely low levels. I mean, even if let's say something is worth 100 million over the long term, it's trading at 5 million. It goes up 100% to 10 million, which is still like a 90% discount. Yeah, it's a 100% rally, but it's like from starting from nothing basically. Um, yeah, I mean, I think it's a total shit show what the markets have become, and again, it's all driven on momentum really. So if you follow all the noise and are a short-term trader, I don't know how people survive in this environment really. Because take gold for example. I mean, when rates went up, gold didn't really go down. When dollar went up recently, gold kept on going. So I mean, and of course, since 2020, gold hung in there and went up to test 2000 or 2100 two times, and the juniors, the miners, were just went lower and lower. So I mean, I just take that as proof. I mean, even if you got the gold price right, you got the miners wrong. Even if you got the dollar right, you got the gold price wrong. Assuming that, well, the dollar's going to go up, so I'm going to sell gold. Well, gold went up, so I that's why I stay away basically from any macro unless it's like actionable. If it's obvious, like, oh, okay, we have a huge debt burden in the world, and the U.S. Uh, deficit is like sky high. When we have bubbles all over the place, would this be a time to pick up some of the generationally cheap resource stocks, especially given that the projections are that we're gonna have a shortage in almost everything up to 2030. Yeah, I think that's a pretty no-brainer. I mean, you can turn on a mine just like that, and it's actually been getting harder to get mines up and running, and some mines are actually shutting down because they run out of mine life, or Panama decides to we're not going to have the quantum mine there. They don't want that operating. So I'm after the no-brainers. I'm not investing you know, based off of rocket science. In my opinion, it's like rocket science is probably needed for trying to figure out what crypto, if there are any, that will actually survive, be around in 10 years or whatever, and or follow 1,000 macro indicators and have some algorithms and whatever. I'm after the no-brainers, and the biggest no-brainer that you can bet on is that the cyclical market is going to be forever cyclical. So yeah, that's about it. But so I thought this is going to be quite interesting for a lot of people in the sense that if this is the real deal, which it really looks like, and again, I've said this before, we have to assume it is because it's so cheap and has been so cheap. I kept saying it's like you buy the lower it goes, because if it's not, let's say a rally is a fake rally, well, you at least know that we're getting closer to the real rally because there's 100% guarantee that a bull market or at least a bull leg was gonna come, and it looks like that is happening. So we have to assume again. We know where we're going. This sector is gonna be overvalued one day. And when we go from these prices to overvalued prices, that's hundreds of percent or even thousands of percent in some cases. Are we there yet? No, obviously not. I mean, they're not anywhere near overvalued. That's the big move. That's the huge mean reversion and then past mean reversion. But a lot of people, I mean, 95%, they of course, as always, want to get everything 100% right. I mean, take the fine silver for example. Let's say this is a proxy for juniors. When we're at these levels, does it make a lot of sense to try and or at highs to like, oh, I'm gonna get every single. I mean, let's say you knew that the fine silver is extremely overvalued up here. Sentiment is super bullish. Everyone is in. It's just a matter of time before we have a down cycle. Should one be playing like, yeah, okay, I know that, but I'm gonna try to catch every single rally, whatever? Yes, most people do that, but it's like, in my opinion, what's the low-hanging fruit? Obviously, when you're at extremes, low-hanging fruit is that, well, from this level to an overvalued level, it's a shit ton of returns in between. So how do I capture that? Well, you buy as cheap as possible. If it goes lower, which means it's more undervalued, you just buy more. And then you have to kind of hold these juniors, I mean this sector broadly speaking, until they're overvalued. If you do that, if you buy extreme undervaluation, wait for it to get overvalued, you're obviously going to make a lot of money. Obviously. That's the low-hanging fruit. But as always, everybody's going to bottom and top pick. Right now, metals are down. The futures are down, for example. I've already seen people saying that they've sold. Maybe it goes down. Maybe you have a correction. Maybe it goes down, for a week or a month or 2 months, whatever. And some people are gonna obviously say, "Well, how smart I was." Because I mean, seriously, most people don't have any long-term portfolio returns to brag about. Uh, so you end up bragging about individual trades, because everyone wants to feel smart and look smart, especially on the internet. Um, so let's go through some topics. I broadly covered these in a K report I just did. 1 second. Sorry about that. Uh, you can fast forward from that. Anyway, so a few topics. Like, first of all, nobody got in at the bottom. Almost nobody. It's like this was actually in the fines, for example. Well, I don't know how low it went. Maybe 9 cents, something like that. I actually was fortunate enough to get into a placement here at 10 cents. But that's like, I mean, how often does that happen? Not often. Did I know, let's say the bull has started. Did I know that? Absolutely not. And I've been participating in a lot of placements that, are in the red. So it's like it's meaningless. But of course, it could be easy. It's like, yeah, look exactly how smart I was to have entered, Defiant Silver at 10 cents because it's up, quite a bit from 10 cents. But that's the drop in the bucket. It's like I have owned Defiant Silver for quite some time. I mostly owned it around these times, I think. I might be down on Defiant Silver from a long term perspective. That's not much to brag about. And at the same time, yeah, I took a decent sized position, but it's like, 1% of the portfolio. But when you look at Twitter, everybody's going to be bragging about their current wins, and you have no idea. It's like I know a few people who constantly brag about every short term move, and I know, you know, that they have, let's say, taken some, big losses in other sectors or whatever before they entered juniors or minors. But again, it's like we don't tend to talk about that. I mean, I try to be balanced in a sense. I don't post any, told you so's really because I know I'm just showing half the picture, if you know what I mean. I mean, success in this sector is, especially alpha success, like exploration success, it's high risk, high reward. You're not typically even going to have 50% winners. I mean, if you had 50% winners from a, 10 bagger perspective, I mean, that would be surreal. That doesn't happen. So you tend to have more losers than winners, and in the bear markets, you really tend to have a lot more losers than winners. And if we get a move like this, which we're gonna get someday, but it's obviously gonna take months. I mean, we have no idea where these juniors are gonna go from here. Maybe they go up here. Maybe here. Maybe they go down here first. Whatever. It's like I was gonna say the only thing that matters is your long-term returns. And to have good long-term returns, you have to have good strategies. So just to get back to this again, almost nobody buys the bottom. That's why it's a bottom. You see these charts, and it's like, let's say, it's up here, and you're like, oh, well, I missed I should have bought here, whatever. It's like nobody buys down here. It's like there's one guy maybe puts a few $1,000s in whatever in one of these, and he might own a 30 names, and he might be down 50% on say 30 names before they actually bought them. So it's like, don't get stressed out, and let's say, what's the word? Don't be depressed by what you see on Twitter, that everybody got in at the bottom and every single stock anyone has is, doing well or running, I mean, that's typically not the case. And you don't, first of all, you don't know their past and you don't know their future. Every single person who was in crypto for a while, or let's say for example, the recent like 4 months, everyone is up. Does that mean that literally every single person that owns crypto is a good investor? Of course it doesn't. I mean, most of the best investors don't even touch crypto. So results in a given time frame says absolutely nothing a lot of the time about anyone's, let's say, investment skills, their past history, or their future history. Their future. So we're not even nowhere near overvalued yet, but again, that doesn't play into most people. Most people, vast majority, do not have a value investor mindset. They buy whatever they think is going to go up tomorrow or next week, and they sell whatever they think is going to go down tomorrow or next week. Price and value is an afterthought. It really is like that. That's why this sector actually crashes this low, because if everyone was a value investor, these juniors would never reach these lows, and they would never typically go as high as they do. That's just a fact. Uh, again, you will never have the best performing portfolio, especially on Twitter, because again, people like social media overall, people lead with their highlights. So people will point out the stocks that are running, obviously because they have FOMO themselves typically, or they just bought into a stock and they want it to go higher or whatever. People don't typically sit there and post a lot of shorts about the ones that are down or have not performed, or again, especially point out the returns. I mean, if you're quick to brag about everything, how quick wouldn't you be to brag about your actual long-term portfolio returns? Why don't people do that? Because most people don't have good long-term portfolio returns. So there's nothing there to brag about. So just try to shut out that noise. It's like my goal, for example, which is a very ambitious goal, is to average 50% per year over the long run, or as long as I can at least have a portfolio that can actually work in the junior space. I mean, Eric Sprott, for example. I mean, how easy would it be for him to average 50%, let's say? I mean, he can't even trade. I mean, he said it himself. He has no exit, really. I mean, a story needs basically to get bought out, because he takes sometimes huge positions, like management, and he can't dump it really. I mean, he can trade in like First Majestic, but even that, which I think he had to sell over the last 1 or 2 years, I don't know how much he sold, but I think he sold a bunch of shares, probably to invest in other places like Newfound Gold or whatever. But look at First Majestic. He absolutely, when there's so few buyers, and the company itself has had problems, and you're in a bear market. I mean, I think from the 2020 highs, I think First Majestic went down like 90% or 80%, something like that. So I mean, they get absolutely slammed. So he can't even trade. The less capital you have, the more nimble you can be. You can get in and out in a pretty a low market cap company pretty easily. So that's obviously also points to, I mean, most people, when they're like, oh, brag about a trade they did, and you look, it's like, well, volume wasn't that large anyway, so they might have had, I was gonna say $5,000 or something at risk, and they made 20% on that in a short time frame, and they brag about it. It's like, yes, that's impressive, whatever, but a return in a short time frame. But if you had a long success of creating wealth, let's say investing, you probably would have a much larger portfolio, and you wouldn't be bragging about $5,000 trades that you got 20% on. You know what I mean? But that's obviously very easy to like, then I'm gonna whatever follow that guy because he seems to nail it. It's like you have no idea about. I mean, it's like I don't really follow any newsletters, for example. I never really did that. I wanted to teach myself how to fish, and I do stuff that makes sense. And to me, it doesn't make sense to be a short-term trader, especially again at a time like this where the big opportunity is to catch. I should actually have taken an even better. Let's see. Oh, I can save this first. So this is First Majestic, for example. I mean, if you buy just anywhere in this region here, and then sell somewhere in this region here, and you buy more, again, I don't actually like First Majestic because I don't think it's a great business. My point is, if you start buying anywhere close to low and just ramp up the buying, something gets cheaper, you're gonna make money every time, because this sector is forever cyclical. And also, one thing to note, obviously, is that people are, as always, everybody plays for perfection. How many do you think believe that this would go straight up like that? Pretty much nobody, because these are such outrageous returns that if the market knew it was going to hit this level on August 2016, it would already be trading up here January 1st, you know what I mean? Because these are absolutely outrageous, like black swan type returns. So nobody has any frigging clue what a junior sector is going to do typically. That goes for me. That goes for everybody else on Twitter, basically. And the only low-hanging obvious things I can see is that when you buy something extremely cheap, from that point to a sector becoming overvalued, that's a huge amount of returns, which does not need precision at all. I don't need to trade every single. Good luck trading all of these small moves, because you can't fathom, having a paper loss. So you need to be looking right all the time. That's what most people do, and that's why nobody really makes any money. I do think gold developers are still cheaper than silver developers. Yes, silver has gone up a lot, but if you look at some, MPVs of some of these gold projects at current spot prices, I mean, they're selling for like, I don't know, a tenth or 5% of MPV at current gold prices. Silver is around $27. I mean, on paper, gold developers or gold deposits are obscenely profitable today. And I mean, this run in gold it's run like $200 in just a few weeks or something. That's a big move. Inflation is not up that much in that time period. So now there's most gold developers actually have, at face value, incredibly profitable projects at this gold price. Today, just a snapshot of today. Silver projects at $27. Are they profitable? Yeah, probably, but I don't think many silver projects are obscenely profitable at 27. But I still see gold developers selling for less than silver developers in absolute terms. So in my opinion, which I've stated for a long time, I think silver juniors tend to trade with a premium towards gold juniors, towards relative to most things, because they have a speculative premium. People don't buy silver juniors specifically because they're cheap, anything like that. They're buying it because they're bullish on the silver price, and history has shown what happens to the silver juniors, which is a leverage bet on silver price. So everybody knows silver can run like hell, and silver juniors become a turbo boosted trading sardine, or trading sardines. But starting to buy silver stocks. I don't remember when I last made that kind of public call on that. That obviously looks quite smart today. It was done on 23rd of was it February actually? Yeah, around here. So maybe around the actual last day of this bear trend. So I mean, that's gonna be fun if that ends up being true. That's like, okay, the one time I actually say I bought silver juniors turned out to be at the exact low, and that's don't get me wrong, that would be extremely lucky. But the thought thought process behind it makes sense, just based on what I keep on saying. Obviously, the lower something goes, the better it is from a risk reward perspective for a value investor. Plus, the longer the bear market lasts, the closer we are to uptrend. So this is by definition closer to the next bull leg than this, simply because more time has passed and no bear market lasts forever. So I mean there's merit or there's logic behind it. So again, it's like some deposits today look quite or very good at $1,800 gold. I mean you can look at some really good ones like Skeena Resources, their Eskay Creek. Rupert Resources, I mean, those are obviously, I mean, kind of top of the line type projects. But they are highly economic at $1,800 gold. And that's $500 lower than here. If you look at silver juniors, if silver went down $3-4, not a lot of silver projects would actually be very economic. So, in my opinion, I still prefer gold juniors, simply where gold is at and where the gold juniors are priced. But I couldn't help myself. I picked up some silver beta, which has done well recently. But again, I said it at that point in time. It's like it's not a very large position because I'm not in the habit of gambling. I don't like to speculate too much. I don't like, let's say, pure trading sardines. And I don't have conviction in those cases. If I think an asset is not good and just hope that people will pay up, greater fool trading, greater fool theory, what do I do if silver corrects $5 or gold goes down $500, whatever? I would be sitting, feeling very stupid because I bought something that wasn't even necessarily cheap, except maybe on paper, but it's like that's not maybe a legitimate project. And then the metals go down, and typically the juniors follow in that case. And I would just be sitting there thinking like, okay, why was I a shareholder of something that I didn't even think was, cheap, and now they've gone down, and there's no real fundamental reason why they should go up a lot, simply because it's like it's cheap on paper, but it's actually not a legitimate project. So again, those are real trading sardines. I try to kind of avoid them, and that's why I don't tend to talk too much about my beta plays, especially my silver beta plays, because of the rationale. I'm much more comfortable in gold developers, gold beta, because I think they are cheaper from a value investing perspective. But I have a few like Defiant Silver. As I said earlier, I actually participated in that private placement because they just had got their Tepal project back, which is a gold and copper project in Mexico. And I remember that they did an economic study. This was years back, where there was a PEA. I think they did it on $1,250 gold price and $2.5 per pound copper price, and it was economic at those prices. And you get that silver asset as well. So I think it went down to, I don't know, 20 million, 25 million. I mean, their silver project is legit. I mean, it's a well-renowned silver district that they're exploring, and where there have been a lot of mines built. And their Tepal project looked absolutely, fantastic in a sense. So if I can pick up two projects, three different commodities, at multi-year lows with a half a warrant, that's actually cheap. I think that's actually cheap. And there are some other legitimate ones, but and I've said before, it's like if you're bullish on silver, it's like the highest quality silver junior would probably be Dolly Warren, because you have the Hecla vote of confidence. You have Sprott in there. It's in BC. It's in Canada. High grade gold and high grade silver and gold. Jon Goodman, I think, is a good CEO. It's not gonna perform the best top to bottom like some 5 million microcap silver junior that has silver in its name and no shot of actually having something really. I mean, maybe 3% chance of actually having a product that's ever going to amount to anything. They will typically go higher, but that's very much speculation. I wouldn't have a lot in those ones because I keep trying to point out, probable returns are much higher value than potential returns. You can't compound a loss. You can't compound a loss, and it's gonna. One second. You can't compound a loss, and it's we want something that works over the long term. And yes, I mean, if you're in the worst stocks at the best possible moment, then you can have absolutely outrageous returns. But you can have outrageous long-term returns simply from betting on quality. Look at the Lundins. They don't invest in trading sardines. They invest in legitimate companies, and they've actually, been some of the best performers, and went up in bear markets. So I would say, and that's why I kind of keep harping on crypto, etc., because I know some people who are heavy into crypto. I know, I have one friend. He's a very smart guy. I don't think he has ever invested, but he invested a lot in crypto, in Bitcoin specifically, and he's only been sitting on his hands basically, as far as I know. So he's up a shit ton percentage-wise in the last, I don't know, 8 years or something like that. But the thing is, and he's obviously beaten most people's mining portfolios. But the thing is, Bitcoin and crypto, etc., it's kind of a one-trick pony. Because people who rode crypto or early in crypto, whatever, my guess is they're not good investors. They you know what I mean? Some of the worst investors who had no idea what they were doing but were just greedy might have bought some whatever, Dogecoin, made a shit ton of money perhaps. So what happens when the music stops in crypto? That the meme coins, like literally created as jokes, go towards their intrinsic value, which is zero, and let's say the crypto market is killed for who knows, maybe forever basically. What are you gonna do then? But if you learn to invest instead, you can make money forever. Not that you're gonna make money every single year, let alone every single month. But that can serve you forever, regardless of what happens with crypto, regardless of what happens with anything else, because you actually taken the time to get patient, force yourself to be disciplined, know how to do due diligence, yada yada. Get the basics right in the commodity sector, obviously buying low and actually being able to buy low and then sell high. If you can do that, if you can force yourself to be able to play Pong, you're gonna make money. But this is because the mining sector is going to be around, I'm not going to say forever, but at least through the end of our lives. So that can serve you, for all intents and purposes forever. And again, it's like we're not only front running what the herd is going to do, we have to front run how we react. And I brought this up earlier. What if gold? It's like I love there's a quote about Napoleon, or from Napoleon. It basically goes something like, you should know what to do if the enemy appears in your front, your rear, your left flank, and your right flank. Talk about being prepared. It's like you should already know how to respond. But most people, of course, buy something because they think it's going to go up tomorrow. That's the plan. And then it doesn't go up tomorrow, and then they have no idea what they should do because that was the plan. Playing every short-term move. So again, just self-reflecting. It's like we have to like simulate different scenarios that can happen in the market, and how we what is the most, let's say, rational strategy to have in light of the possible scenarios. But we also have to account for how we as humans react. Again, that's why I have a hard time today. I don't like, let's say, trading sardines. I don't like knowing that I own something, I put money in something, and I don't think it really has any value. That's just speculations. Like I literally forked over money to own something, own a fraction of something that I think really doesn't have any long-term value, at least. So again, how would you react? Now silver is down 1.9% from the whatever last 24 hours. Uh, do you have a strategy that accounts for that? If I'm in if I am in pure trading sardines, let's say super marginal plays, don't really know anything about management, don't trust management, don't see any specific value creation ahead, probable growth or anything like that, and I don't think they have a project or has a chance of having a project that someone will actually put into production or buy, it's going to be feeling very uncomfortable anytime I see metal's price goes down. Why? Because we always tend to project the future based on the recent past. I know what people are thinking when they're seeing this. This silver rally was a fake out, like many of the rallies since 2020. And people are probably gonna sell because they expect it to go lower tomorrow, etc., etc. But if you're playing the long game and you think that, hey, the shares I own, I think they're trading for 10% of their long-term value, let's say, or at least like a quarter of their current value and a tenth of what I think the base case is for the future. Would you give two F's about this? Would you get shaken out if you own something, you own something at 50 million, you think it's worth 500 million? No, because you're thinking about, wow, there's a long way from 50 million to 500 million, plus I know we're not even close to a sentiment high, a real sentiment high. This is like, what, first month? I mean, we could literally be here or whatever, or here. That's not the big returns was not to like, average down, maybe have an average here, go back to break even, then sell on the first down day. What kind of strategy is that? No, we're playing for the big moves, obviously. Those are the only one that's like predictable. We're not even close to being overvalued. The herd is absolutely not in. There's probably some people on the sidelines that plowed in, whatever. But it's like, yeah, we've seen high volumes last couple of days in some names. But think about it. How much money is that actually? Not a lot. We've had the lowest volume since 2003. So everything will look like high volume relative to, or it's easy to look like it's big volume. But in reality, do you think average Joe is in the junior sector? No way. Not even close. They're probably going to buy up here. Now it's just people that are aware and have been waiting for the bull. And like always, people tend to they buy in when they think an uptrend starts. And that's why I always keep saying why I prefer to average down. Because, okay, we had a move like this. I mean, it broke some kind of resistance line, whatever. Uh, that proved to be a fake rally. That was not it. So if you bought in here because now you're getting pretty sure that it's start of something, that this was the bottom, and you don't want to miss the rest of it, well, you lost, I don't know. Oh jeez. You actually got a 35% haircut in a month. And what's the plan then? Because your plan seems to be that, oh, I'm going to buy in when the coast is clear, when I know an uptrend has started. So if that's your strategy, now you're minus 35%. What are you going to do then? That's what I keep saying. It's like a good strategy has to account for stuff like that. The strategy that is the simplest, in my opinion, buy cheap, continue to buy the cheaper it goes, and then wait for it to not become cheap anymore. Then you're gonna average down. Then you don't really care. I mean, who cares if this was the fake top or whatever? Even this, for example, it's like, okay, went up. You didn't know if this was it or not. Okay, it proved not to be it. So you just keep averaging down, and then you're gonna have I don't know, if you ramp up the buying, the cheaper it gets, the more extreme it gets, which you should, because the risk reward becomes exponentially better. Maybe you're down here in your average, just from buying all the way down here, even if you started with an average up here, whatever. So then, I mean, you're going to catch quite a big move here to maybe up here. I mean, if you have a sizable position, whatever, that's pretty good. And some obviously did way better. And this is actually, one, in my opinion, almost a pure trading sardine, because First Majestic has, as far as I remember, never really been a good business. And that's why it's like I don't particularly like trading sardines, because the time is not even on your side. You have to play every big cycle. You can make a lot of money in them in a short time period, but it's like there's no margin of safety. Anyway, so this is an article from the Big Score website. It's by Tommy Humphries. He interviewed Jon Goodman from Dundee Corp, Dundee Capital Corp, or Dundee Precious Metals. I think he has a few interesting notes in here, like pet peeves, let's say. Then there's net present value. Goodman says it's a weak metric since commodity prices assumptions are less reliable as time goes on. To him, the most important thing is how fast a new mine repaid their capital cost. Which, I mean, kind of makes a lot of sense, because let's face it, we know what a mine was worth after it's closed down. There are some mines, which he goes on to say, most mines start off with a 10-year mine life, and you wake up 10 years later, they still have a mine life for 10 years. Take, I think it's North Parks in Australia, where Inflection is, exploring. I think that has, I don't know, I mean, that's been in operation for quite some time, and I think they have a huge mine life left. So it's, I mean, if you have a mine that's like, okay, it can be producing for like 50 years. And you have no idea what the margins or commodity price is going to be over 50 years. I mean, it's kind of impossible to actually calculate NPV. Well, all you know, it's going to be way off. But that's a very interesting point. And that makes me think about, again, it's like the benefit, let's say, of a large land package where you can start up a mine and it can grow. It's like there can be satellite deposits, whatever. That's actually what I think Agnico, for example, is focusing on. Low capex growth, meaning they want to find ounces near their primary operations. They don't need to build a new mill, they don't need to whatever. So from a business perspective, think about how valuable that could be, instead of having a small land package. It's like Quinton always says. I mean, the majors, they want to see a large land package typically with a mine, because they want to feel like they're buying and they're going to pay up for it. I mean, part of the premium, for example, is typically tied to the undiscovered ounces in the ground. And I know CEO I talked to, he's like, you always want to leave the blue sky for the acquirer, in a sense. I mean, you want to kind of show that there's blue sky because that makes them more comfortable paying up. Because let's say they buy a mine with a 15-year mine life, but they think there's like, hey, we think we can find 10 years worth of ore on top of that. Obviously, they're going to be more keen to pay up. And you're not even gonna need to find it, but it's like you get paid up front for the potential of the undiscovered ounces. Um, then we have, yeah, I mean, he brings up a example. Long life mines are NPV irrelevant if you can buy them for. This is interesting. If you can buy them for a quarter of NPV, you're really buying it for 5 or 10 cents on the dollar of what they're worth. You don't need a lot of those to be very successful in this business. Dundee Corp avoids high capex projects. When I look at a porphyry deposit, if you don't have a high grade starter pit, you don't have a mine. I mean, that I guess does not apply for block cave operations. But still, I think it's a very interesting piece of information. And that's why it's like, in my opinion, I find copper exploration extremely hard. No junior really has an easy time proving up a porphyry deposit, first of all, unless they, hit the meat early on. They can have some of the most outrageous value creation curves because if you have let's say, a high-grade compact porphyry and you're lucky enough to hit it, I mean, you can prove up a lot of tons quickly, like, a snow line, but at depth. Because it, a big bulk disseminated system and all that. But still, I think it's very, very hard. That's another, reason why I like Inflection, that AngloGold is actually funding that. And I mean, let's think about what are some of the, copper mines, copper porphyry mines are some of the best mines in the world. They have very long life. They can be very long lived and can just, throw off cash for 50 years or more. I mean, they can be kind of priceless in a sense. But that's what it feels quite binary. That's like, either you find something huge, requires billions of dollars in capex, but it's a world-class mine that can be producing almost forever. It's like Cadia, for example. I mean, that's just, I mean, probably a large part why, who was it that acquired it? Newmont, right? Yeah, Newmont acquired Newcrest. Because Cadia is like, I think it produces around, I don't know, 1 million ounces of gold per year or something. At very low cost. So those are absolutely priceless. I mean, Cadia, I think, one of those mines might be worth as much as, 5, 6 mines. Decent mines, let's say. But they require a huge amount of capex, obviously. So it's hard for juniors to go after them. And how do you know what a, good porphyry is? And a junior can't really force the hand. It's like they can never threat to build it. It's like, let's say it's a, tier 3 or tier 2, whatever. But it's not enough for a major that can fork up billions of dollars to buy it. In that case, I mean, you have no shot really of building it yourself either. So then even if you have something that's worth something, you kind of end up in, trading sardine limbo hell. So I find copper exploration tricky. That's why I tend to swing for the fences kind of story. I mean, they are, in my opinion, some of the highest risk, high reward. I have some porphyry exploration stocks like Mogotes, Sendero, Inflection would be the big one. But I understand the high risk, high reward nature in those cases. That it's like, okay, odds are stacked against you. But if they find something, and then it better be good and big, mine worthy, then that can be almost priceless, if you know what I mean. Hugely asymmetrical risk reward. Whereas you don't typically, that's not necessarily what I do when it comes to, gold, whatever. I mean, you can put in a decent mine in production, even a small high grade mine. So the spectrum is so vast, in my opinion, in the gold space. And that obviously comes down also to like infrastructure and all that. It's like Snowland was kind of binary in the sense that, hey, if they hit, it's got to be big because they're out in the middle of nowhere. So I kind of treated that as a porphyry play almost. But they ended up finding a tier one deposit. I mean, that from an economic perspective, I mean, I don't know what the infrastructure cost will be at least, but I mean, that blows Rupert away, it blows Skeena away if it would be up and running. Uh, but yeah, I mean, mostly, would agree with that. But it's always like everybody has a different style. You have some who are like commodity agnostic, some are jurisdiction agnostic, some only go for gold, some don't like porphyries, some like porphyries, whatever. So there's no real way of, okay, what are some universal laws? I mean, I think this, for example, makes a lot of sense. Because I mean, this is a fact. Commodity price assumptions are less reliable as time goes on. Most mines start off with a 10-year mine life, and you wake up 10 years later, they still have a mine life of 10 years. I mean, we also see that a lot of the time. So that's, I would say, are probably universal tips. But again, that doesn't feed into a trading sardine narrative. So these concepts, I mean, they apply for, let's say, actual investors, and he's obviously talking as an actual investor. Uh, because they make large investments and they can't afford, I mean, they can trade in and out like it is a trading sardine. They want to pick up, I mean, he obviously feels that if he's paying a quarter, if he is buying something at face value a quarter of the MPV, he actually thinks that they're actually buying it for like 90 to 95% discount. That's a pretty big deal. Again, if you are a businessman, that's obviously a huge difference. Not only is like a quarter of MPV is already cheap, 75% discount, but to go from to 90 to 95%, or have that as a valid option, free option, that's huge. And wait 1 second. He also, I mean, briefly covers Magna because they have, they have a 21.5% stake. Um, that's not bad. I mean, that's some vote of confidence. Because this guy and Dundee, they are investors. They're not a mining company. They're not, a typical fund or whatever. I mean, this is like the smart money. And on the topic of value, I mean, I can't come up with a lot of juniors that I think have more like solidified value than Magna. Magna is actually a stock that if I had the money, would be happy to buy out and take private at this market cap. I think Magna will throw off more cash, have a much higher return back to me as a 100% owner than what I'm paying for it in the open market. Not that I can absolutely guarantee that, but compare that to like an early stage exploration play. It's like what, maybe 5-10% chance they're going to make a discovery. Maybe there's going to be 10 years to actually see some cash flow, and then you don't know what has happened in between in that jurisdiction or in that local community or metal prices or whatever. So no, I think it's just an interesting tidbit. I would also point out, which is kind of interesting, there's like even zinc. I mean, look at these two candles. They're kind of, I'm not gonna say unique, but hey, something might be cooking that we're actually. I mean, copper is over $4. Silver broke out of the 26 range at least. Well, for now. Gold obviously has been hitting new all-time highs. Long-term zinc short. So it's like what better time? Are zinc juniors cheap? Yeah, I think zinc juniors are cheap. Are copper juniors cheap? Yeah, I think copper juniors are cheap. Are gold juniors cheap? Hell yeah, they're cheap. Super cheap. Silver juniors, yeah, they're some are kind of cheap. But again, that's more of the speculative thing, and that's also one thing I think plays a large part. Again, if you know you are on the sentiment trading side, I doubt. Well, not that I can remember at least. I doubt zinc has the same like possible euphoria phase like gold and especially silver. So if you're playing the beta route, obviously that has to play a large part how the herd behaves in a specific metal. From a business perspective, if you're a pure value investor, you don't really care that zinc stocks doesn't become like grossly overvalued, maybe like silver juniors can do, because you would be focused on the business side of things in that case. Again, if you didn't have a real exit plan. That's one thing I was gonna say, keep in mind perhaps. Maybe a few extra. I was actually gonna cover a few more companies, but maybe I'll do that in another video. So okay, I've talked about this before. Anna, maybe I should actually have a yeah. Okay, so let's use this actually to go over this. Okay, so since 2021, this was the silver squeeze, I think. But let's say almost 4 years. Let's say almost 4 years we've been in a bear market in this mining space, especially in this junior mining space. So, what worked over this period? Quote worked. Alpha, pretty much only alpha, beta got absolutely creamed. So here we have it. First Majestic down 82%. Bunch of juniors like where is it? Okay. I switched charts. Defiant Silver down 90%. A bunch of other silver juniors down 90%. A bunch of other beta gold juniors down 90%. And alpha as well. The ones who, didn't make a discovery and all that, which are, is the majority. But there were a few stocks that did well. Those would be typically the ones that made discoveries. And again, if you have 20 juniors looking for a discovery, maybe 2 work out. Okay, so the only real way, or almost only real way, you made good amount of money in this space over the last 3-4 years would have been if you were concentrated in alpha plays, or you were a good, let's say you were a good trader, yada yada, or maybe you like it feels like what I'm doing sometimes, like something just, let's say something crashes and it's like, okay, this is just way too cheap, then you buy into it, and then maybe it goes up and 50%, and all of a sudden it's not that cheap anymore, and you sell out. Because it was an absolutely no-brainer, even though we weren't this low, and then it jumps back up, or you think that's like, okay, this is an overreaction, whatever. But typically speaking, what people have been taught to do over the last 3 to 4 years is to go bet on alpha, exploration risk, and be concentrated, because most exploration plays don't pan out, right? So that's been increasingly a focus, because that's again the only thing that worked really. It's like the snow lines that I'm trying to come up with some other ones, like lately, what's it called? Reunion Gold. You have Reunion Gold. You have. I'm trying to come up with some other ones. Founders Medals, for example, stuff like that. Exploration plays, they worked. etc., etc. People obviously, again, recency bias. We get taught it's like, okay, you got to be in alpha place. I know a lot of people. There's like they're pretty much only in alpha place. If we knew we were gonna go from here to here, I mean, if we literally knew this is what the sector was gonna do, we would want to be diversified, not concentrated, and we would want to be in biggest beta plays around. The ones that don't need to have any sort of specific catalyst. You don't need a 5% chance of hitting something in the ground, making a discovery. They would just go up hundreds of percent based on the success they've already had. And that's also something I've been talking about. Is like the more we get taught, obviously, the less people look at beta because it's been shittier and shittier and shittier, down more and more and more. And people are more convinced and have even more history as every year has passed that alpha is the only bet in town really if you want to make any money. Obviously it's going to skew it towards alpha and away from beta. I mean that's why some of these exploration stories like Hercules like got lit on fire, huge, absolutely huge volumes. But what has happened since the market started to pop? It was the beta plays that have popped 50 to 100%. The alpha plays kind of stalled, which again makes a lot of sense. But is it wrong to be an alpha? Absolutely not. If you're very good at picking, exploration plays, alpha is an all-weather approach. It can work in every time frame really. If you make a discovery from this point here, you can make a lot of money. Yes, that's true. But obviously the low-hanging fruit and my preferred vehicles are the ones who have beta and alpha. They have some kind of ounces in the ground or a probable resource, even though they don't have a resource yet. But they have that alpha thing. So even if this market continues to kind of suck, they can, climb in value. So, the price to value gap just keeps on expanding, and they might even be able to do well in a, neutral to pretty crappy sentiment environment. And I think so it's like people have asked me about a valley, for example. That's been a rocket recently. I think I owned it for a while some years back. I was tempted. I had planned to pick up some shares around 10-15 cents because Newmont was a partner, so that's third party validation obviously. Big land package in Cote d'Ivoire, or what's it called, the other name for it, I don't remember, but I think you know what African country I'm talking about. And Newmont was funding it, so it's like obviously cheap on a risk reward basis. But then they drilled a good hole, and it's like, oh, that was impressive. Went up, and it's like, I mean, that's a good start, but I didn't have really time to really dig into it. Then they drilled that, what was it, 50 meters or 26 grams per ton, and it caught on fire. It's like boom, boom, or a boom and an even bigger boom, and it was up like 600% or something. I know quite a few who actually, owned it near the lows. And I mean, they're, laughing to the bank right now. And they took a risk, and they've been paid for it. But I was not willing to. I mean, it traded up to what, $1, $1.1 maybe. I think at the time it went up to like 60 million in market cap, I think. The thing is with that Charger discovery, if that ends up being a real good discovery that's like Newmont would like, they get 25% of it, and Sandstorm has a net smelter royalty on it. I think it's 2%, and a rule of thumb that I've learned is that 1% NSR is about 5% of the project in a sense. So you have a NSR which draws down the total project value, because let's say approximately 10% of the value of the project is going to Sandstorm, and then you have 25% of what's left. So at 60 million, that's like, almost, assuming Newmont would earn in, then you have a 20, and then of course, if success really does happen, Newmont would earn in, because it wouldn't be too expensive, I don't think, to earn into 75%. Anyway, then they would keep, less than 25% of it. So in one future scenario, you're kinda already valuing it as a success, and implied value is 240 million, more than 240 million, let's say. That's excluding dilution and whatever. And the fact that, okay, that was drilled in a breccia pipe, and breccia pipes are kind of known to be, they can be very high grade, but they tend to be very, or quite limited in scope. It's like the volume typically is not there, whatever. It's like, you see some flashy headlines sometimes where juniors drill right down the pipe, down the throat of a breccia pipe, and they come out with like, whoa, 100 meters, 200 meters of very good grades, but that's it, and it still doesn't become a mine because it's a breccia pipe. It's cylindrical, it doesn't have the tonnage, etc., etc. So that's also one thing to note, I would say. That is like, when you think about it, that's a world-class intercept, obviously, 50 meters or 52 meters or 26 grams per tons. Still, one could say it infers a 240 million project already. There's not a lot of gold juniors out there with a 240 million, or a project that's valued at 240 million. Like when I think about, got me thinking about Mawson, for example, their high grade or bonanza grade discovery in Australia. I think Southern Cross was recently valued at like 350 million. That's 100% owned in Australia, and it's already probably a mine. It's not one hit, it's already pretty much a mine, a lot of sunk costs in it already, Pierre Lassonde. So it's like, when I think about it, it's like, okay, would I want to pay or infer 260 million or 240 million after a high-grade breccia hit in Africa, or buy what's already probably a mine in Australia, which could become a multi-billion-dollar mine, for 360 million? In that sense, to me, Avale didn't. That's not a no-brainer to me. But that doesn't mean, again, it's like I never know what is actually gonna happen. That could end up, we don't know. Maybe that turns in, or their land package. Maybe they make more discoveries. Maybe the Charger drill hole is just the start of something. It gets even better at depth. Whatever. It's like a million ways this could go yet. I'm not in the habit of exactly trying to predict what happens, especially in an early stage discovery story. It just, to me, the risk reward at whatever 60 million. Now I guess it's at 50, so it's lower. It's not convincing enough at this point in the market cycle. Or I should put it like this: it might very well be a buy. It's just that, to me, finding a buy is not hard right now. It's finding the best relative buys. If that makes sense. And I'm obviously going to be biased against Avale since I don't have a position. Well, I actually bought 2,000 shares just to keep track of it after the first hole. So it's like, that's why I typically don't talk about stories I'm not in, because I'm going to be biased against them. And typically I'm not going to know enough about them. So these are just like high level, quick, or like how I thought when I looked at Avale after the run up. just again how I kind of quickly try to discern, like, because I have no real problem in chasing, if you know what I mean, because I think that's a mistake, and I've talked about this before. That's a psychological mistake that oh, you never chase. Well, I mean, there's times when you really should chase. The news is so good that even if a stock goes up 100% or 200%, it's still cheap. I simply don't see it as an absolute no-brainer at when it traded at 60 million. That's all I'm saying. I hope that makes sense. Uh, and again, I'm not saying sell Avali. It's like I might be buying into it tomorrow. It's like uh, we don't know what's gonna happen. I might change my mind quickly, but just my 2 cents, my short look at it. I just, again, comes down to the risk reward. I simply don't. I mean, is there a guarantee that they even have a mine there? No, there's no guarantee. But I think there are some projects out there that are cheaper than a valley that have a 80% chance of having a mine, let's say. So then it comes down to the risk rewards. Like a valley might find a whopper of a discovery. It goes from 50 million to 500 million. So I mean, it goes up 10 bagger 10 times from here. Or maybe they make a discovery just on the JV property, and maybe they make world class discoveries on their 100% owned. So I mean, theoretically it's limitless, right? When you have a large land package and all of that. But that can be said, of course, for a lot of juniors. Theoretically, the sky is the limit. It's the downside that is fine or known, that is anything can go down 100%. My point is simply that at this stage in the market cycle, when we're down here, I think beta has more merit than alpha. And in the case of a valley, that is like after the run up, I don't have a problem to chase, because again, I at least took a tiny position after the first holes because it looked interesting. It simply ran up so much that I don't think it's an absolute no-brainer. But that doesn't mean it can't become a 10 bagger from here. I'm gonna miss 99.9% of 10 baggers anyway. Uh, but it's all about, again, risk reward. Thanks for listening. I guess I'm gonna cover some other juniors in another video. This became a very long rant already. Again, not investing advice. I'm not. I mean, in a value, for example, I'm not saying you should sell or buy that. It's like nobody knows how any exploration story is exactly gonna turn out. Um, if you're a shareholder, you roll the dice and you would get an eventual price. If you're out, you don't get a shot at it. You obviously don't take the risk as well by definition. So it's like nobody knows. Nobody knows, but it's just an example because people have asked me about this. So these are just my uninformed 2 cents. That I don't know enough of it, and I simply, given what else is out there to buy with much lower risk, I simply don't think it's not a no-brainer for me. It's not a no-brainer at this price, and that might end up looking really stupid in the future when they show it's a world-class discovery. But that's the markets for you. I mean, nobody knows for sure. We can just try to estimate what cases provide the best risk reward that fits our profile, our risk profile, and our diversification needs and all that. Not investing advice. Thanks for listening. Consider me biased if I mention stocks. I might own them. Some might be sponsors as well. So twice biased in some cases. Thanks for listening. Bye.